Hey, I'm Mike Priest, the founder and CEO of Visible. As you scale your company, having the right guides at your side can make all of the difference. Each episode will talk to fellow founders, investors, and experts. We'll dive into their zone of genius, as well as hear about their past mistakes to give you a better chance of success. This podcast is for founders by founders. This is The Founders Forward.
All right, everyone. Welcome to today's Founders Forward episode. I'm joined by, I believe, three-time guest now, Elizabeth Yin from the Hustle Fund. She's a co-founder of the Hustle Fund, a general partner there. She describes herself as a recovering entrepreneur and marketer. You might also know her as DunkHippo33 on Twitter. Elizabeth, I think you guys actually announced this earlier this year in February, but Fund 2 has been announced, a little over $33 million. So first of all, congrats on that, and welcome back to the show.
Thank you. Thanks, Mike. It's great to be back.
Yeah, awesome. So, today we're really framing season 2 all around helping founders get into the mindset of the investor to hopefully help them become more successful with their fundraising efforts, whether it's pre-seed, seed, Series A, etc. And so just to help set the context for yourself and Hustle Fund, you describe yourselves as investing hilariously early. So what does that mean? Like what stage are you guys investing at, and where do you spend most of your time?
Yeah, it's funny. The nomenclature is kind of all over the place. Like, I call ourselves pre-seed investors, but pre-seed means a lot of different things to different people. So what do I mean by that? We generally invest post-product, but pre-traction. Like, we do not care if you already have customers or not. Obviously, after we invest, we would love for you to get customers, but we invest actually quite early. We're not looking for traction or anything like that.
What about product?
Yeah, and even product can be quite rough. We'd like teams to have done something. So there's sort of this spread between when you thought of the idea and now you have a product, and there's kind of everything in between. I think as long as you have something to show where you can say, hey, even if you're manually concierging the product, that's fine.
Okay, that's fine. We're going to go off the rails here because when we were doing our pre-chat, we were just talking about how people can't get enough of fundraising content. We would love to talk about customer acquisition. Let's just talk about customer acquisition just for a second. And I'm putting you on the spot, so maybe we have to edit this out, hopefully not. But like, what are you seeing now? Because I mean, I think you guys were doing 12 deals per month during COVID, and maybe even more now, I'm not sure. But like, so you're helping a lot of companies at this point. What is like the latest on early stage customer acquisition? Are there any trends or things you're seeing? Or is it kind of the tried and true, customer acquisition funnels that have been, here for a decade plus?
Yeah. Well, I think number one, we are doing just a lot of deals. It's actually a little bit ridiculous. We are doing 12 to 15 deals a month right now. And that has been pretty sustained since last summer. I think we had a slight dip in the winter, but then it has picked up again more recently, the last 3-4 months. So
awesome.
It's been kind of nuts. And I think a big factor is actually it's unrelated to COVID. It's unrelated to really anything that's going on in the world, but just the sophistication of entrepreneurs, I think, is quite high relative to when I was starting my business. Mine, when I started my business, it was in the dark ages. It was pre-lean startup. Like, Eric Ries hadn't even come up with his book or whatever. And so I think that entrepreneurs generally are thinking about how to de-risk their businesses better now. And I think that's kind of what's led to this. And so what are people doing? They're doing things like pre-selling before they have a product. And this is kind of what I mean. Like, product can be rough, but we want to see that you are doing things and generally thinking about things in the right way. So very big proponent of the lean startup method. Like, for most software businesses, the biggest risk is that customers don't want this or they won't pay for it. And so how can you de-risk that? What is the minimum that you need to do in order to start selling to prove that? So are you having the customer development calls that you need to? Do you have a good understanding of your customer persona? Have you had a lot of interviews? Have you tried to sell this product? Are people paying you even if the product's not there, or if you're taking checks to your personal checking account or whatever it is? That's what we like to see. And those are the kinds of businesses we're funding at this stage.
Okay. I think you talked, I think you might have put this on Twitter this week, like when's the last time you talked to a customer and tweeted that? Anything interesting come from that thread? I think a lot of people responded to that. Anything that you saw or was an interesting takeaway?
Well, a lot of people responded that they are talking to their customers, and some people said that they were reminded that they should. I mean, I think it's a good thing to always come back to, even especially actually once you get going and you do have a product and now you have a team to manage and you have all these other things,
Mm-hmm.
and then things are not quite working as well as you had hoped. I mean, very often the question that I ask my portfolio founders in that scenario is, okay, like somebody tells me, oh, people are churning. And then I ask them, did you talk with the people who churned and find out why? And actually, as funny as it sounds, actually very commonly people I don't think end up talking to their customers enough, like even just to ask a simple question, either because they're really busy or because there's a fear of what the answer would actually be.
Mm-hmm. Scott McCorkle, who's a CTO of ExactTarget that got bought by Salesforce, he talked to a customer a day, which I thought was pretty interesting. Like that was his thing. Even if it was the same customer, like he might call up, someone, 2 times in the month or whatever, but he would literally talk to a customer a day, and that was his goal. I tried to do that. It's actually a lot harder than it sounds to talk to a customer a day. But we literally are going through a lot of customer development for a new feature we're considering right now. Our goal was 30 customer interviews in the next 2 weeks. And that's actually a lot of work too. But one of the things, just to go back to talking to customers, is you also are reminded of things that like work really well too. Maybe things that, yes, it's great to hear where things suck. But then like today I was reminded, someone's like, hey, I love reading the Visible Weekly. Like it's so great. I get so much value from that than other newsletters. And I shot a quick note to the marketing team, like, thank you, this is awesome. But sometimes you also forget like what got you to where you were and like what works well. So it's fun, like getting back into the weeds and doing a lot of calls back to back with customers. So
absolutely. And I think that's amazing that you're doing that, because to your point, actually, once you get going, I think that it is really hard to talk to customers because you have so many other responsibilities. Mm-hmm. And I think a lot of people think, oh, just talking with customers at the earliest stages is sort of one and done, but it's a continuous process. And to your point, Mike, I think learning what actually people love can be great in other ways too, where you can actually choose to double down and hone in on that specific thing. And the other thing you learn is the messaging that your customers are using to better convert your customers as well. Like, what is the language they're using? They may be calling it something completely different, which is actually very common, even if you don't change anything about the product at all.
Yes, that's so true. It's like, what do I call this feature? And we, bang our heads against the wall of like copy. And it's like, oh, we'll just talk to customers and hear how they describe it. And then usually a trend emerges like, oh yeah, duh, like we should have just done that the entire time. And then one other quick little anecdote that I thought was pretty interesting is we have like a very light fundraising CRM founders can use now to manage a fundraising process. And when we scope the feature in the MVP, I was like, we don't need multiple pipelines. Like you're only raising one round at a time. Like we don't need to support multiple pipelines in MVP. And we haven't since we launched the feature like a year ago. But through these customer calls, we heard like 3 in a row where they're like, I really wish I could do multiple pipelines. I'm really having to hack my way around it because I kind of have like a scenario A and B, like here's my angel kind of path. And here's if I do like institutional route. Some people just want to archive or save a board. So like we learned things that like I thought were obvious, but just heard them so many times that when you talk to customers, like trends certainly emerge. So it's been fun, like getting back into that. Because yeah, admittedly, probably didn't do it enough earlier this year.
Oh, that's cool.
Yeah,
I like that.
But okay, at least we talked to some customer acquisition marketing, so I'm glad we did that. But today, want to pivot back to founders raising a pre-seed seed round. You guys launched Angel Squad, and it's pretty cool to see what's happening. Like it's kind of like on deck, where you start to see on Twitter people are putting they're like an Angel Squad member, and it's like a badge of honor that they're wearing, which is cool to see. So I guess quickly, like what is Angel Squad, and maybe more importantly, like why was now the right time to launch something like this as part of Hustle Fund?
Yeah, so Angel Squad is a new initiative that we launched at Hustle Fund just, I don't know, less than a month ago, I think now. And essentially what it is it's, I guess you could call it a modern day angel club or angel group. So if you can imagine the older version of an angel group is a bunch of rich people get together and there's some social gatherings, and then they look at deals and founders pitch them, and maybe they invest, and then they kind of teach each other how to angel invest. And that's kind of the concept. Well, if you could imagine, like, what would that look like as a sort of a version 2.0, that's essentially what Angel Squad is. We provide education on how to invest in startups, at least from the perspective of Hustle Fund. And we, certainly like to cultivate the community as well. It is entirely online, so we're talking about a global community. And then, lastly, of course, we do share deals. Certainly, it's a way for angels to invest alongside us at Hustle Fund, but also the squad members are starting to bring their own deals as well and invest in each other's companies that they're bringing. And I think that's the ultimate goal, which is, I think for Hustle Fund, taking a step back, our mission is to help with essentially three things for startup ecosystems: capital, networks, and knowledge. I think those are three things that are really critical for an entrepreneur to be successful. And you see those three things in certain circles or in certain geographies. Certainly, I think San Francisco does this better than many other places in the world, but there's talent everywhere. And so those three things are not distributed evenly. And so we're trying to kind of further all three. And Angel Squad is an initiative that helps provide more capital. I mean, I think we certainly have our VC fund, which does that, but there's only a limit to the number of companies we can fund. But in theory, actually, if we can bring in thousands of new angels or tens of thousands of new angels, then you can actually broaden the scope of capital. And they, of course, are very influential in bringing their friends to the table as well.
How's it going to work from a like a deal perspective? You guys share a deal. Hey, we just invested. We're super excited. Are you going to create like an SPV that's managed by Hustle Fund, or what do the dynamics look like for like when the rubber meets the road? I'm not sure if you guys are even can share that or not, but I was just curious.
Oh yeah, we're an open book. So we have been doing deals through Angel Squad already. We aim for about 2 to 3 a month. So not quite one a week, but we think that's sort of a reasonable pace, at least for right now. And the way it looks like is it is an SPV that we run, at least for the companies that we are bringing to the table, which are existing Hustle Fund portfolio companies. And we are also, putting in another check as well. So we have skin in the game. I think that's something that's really important. Certainly you see a lot of platforms where people can invest, but there's always this question of how much skin in the game do the sourcers have. So we do have skin in the game. And then angels can invest alongside us in these SPVs. And then some of the deals that are coming to the table that are not Hustle Fund portfolio companies, initially they have been sourced by us as angels, and we have skin in the game as angels. But the newer ones from the squad, similarly, they are, they're sourcing and they have skin in the game, and also shared economics on the SPVs as well.
So if I wanted to map, so if I couldn't be an LP in Hustle Fund for whatever reason, right? There's a limited number of investors you could have in Fund 2 and all of these other dynamics. I could join Angel Squad and almost map your portfolio if I just participated in every deal, theoretically.
Unfortunately not. So unfortunately not. So we do bring forth deals that are great. As a result, actually, as I mentioned, we are investing again at the same time that the Angel Squad members are. So there is strong signal there, but we don't bring every company to Angel Squad. Okay. Yeah. That unfortunately is just impossible, as you can imagine, because some companies are just way oversubscribed or whatever.
Yeah. Modern day angel group. I love that. Like when I think of angel groups, when I was just starting out, you would go and they'd be like, hey, I'm raising a round. I'd be like, great. Come meet us in 60 days at 7 p.m. and you'll compete against 3 other companies in pitch. We'll grill you with questions and then you won't hear from us for another 30 days. I was like, well, that timing really doesn't work. So I'm glad that you guys are taking a more modern approach to like map how it actually like fundraising actually works,
This
which is great.
Fast, because I totally hear you from personal experience. Angel groups in general tend to move very slowly. But I mean, much like the fund, this group can usually turn around and answer anywhere between 48 hours and a week. It obviously kind of depends on the deal, but we do set expectations very clearly with every company, like how much we think we can deliver, and then whether we hit that or not, we can give them a quick answer in 48 hours for the most part.
Love it. Some of the things that you've been talking about on Twitter, it seems like more recently, are small checks. Like, you know, not the standard $25,000, $50,000 angel checks, but smaller ones. And I think yesterday you posted some pretty interesting things around supply and demand. And so, you know, fundraising tends to be a supply and demand game, requires, you know, FOMO. Kind of going on the theme of small checks. How does a small check cater to turning into like larger checks or larger fundraise?
Yeah, so one of our portfolio companies called Fresh Paint, the founder wrote about his fundraising experience. And funny enough, one of his small check writers actually introduced him to so many different investors, funds, and angels that he ended up raising the bulk of his round through that one person. So small checks can really deliver credibility, social proof to bringing in more money, which I think is something that is often overlooked. And we certainly have found that to be true with Hustle Fund as well. Like when we were raising Hustle Fund, some of our smallest check writers, you know, $10,000 or $25,000 helped us get introductions to much larger checks. So I really do believe in the power of small checks. Like, I think you have to look beyond that small check. And so then the question is, well, since most people don't actually see the value of a small check, at least at this point in time, how do you as a small check writer then kind of convince somebody of this? And I think this is where ultimately it is a sales game. You might have to sell your check a little bit more than a larger check writer, but it's definitely possible. Like as an angel, I have written $1,000 checks, and I'm not even talking about SPVs. I'm talking about direct. And you really are selling, like, you know, I will not be in your hair. I will make fast decisions. You know, I can help you potentially introduce you to people or whatever, and you're selling that.
One of the things that you know, I saw that I started is like, man, I would love to help other founders. Is I guess I should put the caveat: this is like not talk to a lawyer or your accountant, but a lot of founders can actually support other founders through the equity in their business, right? If you have a certain valuation and you have a certain ownership, you probably count as an accredited individual already. Have you seen anything interesting with like founders coming together to support other founders through smaller checks?
Definitely. And so this is exactly the perfect use case because people often wonder, well, if you're really an angel investor and you're rich, why are you writing small checks? And I think when you think about the people who are accredited but don't have a lot of liquidity, they do tend to be startup founders or people heavily invested in startups of some sort, right? So this is the perfect use case. I'm no lawyer also, so I can't speak to the accreditation laws, and I think they are honestly a bit fuzzy, but this is actually how a lot of people, at least out here in Silicon Valley, are running around and writing, you know, $1,000, $5,000 checks. Like they are accredited on paper through, you know, their startup's valuation. Let's say it's, you know, they've raised money at 10 mil post or whatever. There you go. Like you're easily accredited, but you may not have a lot of cash. But it's very actually helpful because I would love to have entrepreneurs in my round, and actually even for our fund at Hustle Fund, again, like going back to how we do have small check writers in both our funds 1 and funds 2, they are largely entrepreneurs. They're very well connected. They know other investors, they have their investors, or they know other entrepreneurs. And, you know, this is the network you want, right? And as a founder as well, you know, you often want introductions to other VCs or whatever. Who better to introduce you than somebody who's already in the portfolio?
It's becoming super prevalent. Even, I mean, AngelList has a whole product related to even helping have, you know, if I'm a founder and I just want a consortium of more founders, they have like the roll-up vehicles now that make it super easy for you to like take a bunch of small checks, you have one line on the cap table, so you don't have to manage like a ton of cap table messiness, and you're able to bring on all of those founders right on your cap table. So I'm loving some of the innovation that's happening there. There's a lot of companies that are now spinning up to even let you create SPVs at scale for a fraction of the cost of what it used to. You got Angel Squad. So I think it's going to be just a trend that's going to stick for a long, long time. I mean, you're even seeing it like in the biggest rounds, right? I think Front, I think their most recent round was like now it was a big round. It was like 60 million plus. And so it was from highly liquid, very wealthy founders, but like successful founders led that round, which is pretty interesting.
Yeah, 100%. Notion also did a round, I think maybe not the latest one, but the one prior or something. And I believe it was like a $10 million round, all with operators. So I think you're going to see VCs be rivaled by a lot of these operator angels. So they're small check writers for sure, but then some of these people are also large check writers too. And then you get sort of the party round of both. So that way, you can bring a lot of really valuable people to the table. And I really do think that that's the dream. I mean, certainly the dream for us, like with our fund. And I think, yesterday, Ryan Hoover announced for Weekend Fund that he had raised a Fund 3, and largely from, I forgot, hundreds of, entrepreneurs and angel investors. And that's what he's trying to do, because he wants these people to bring deals. He wants them to help out his portfolio companies. He wants some of them to start companies, et cetera. And I think that's super smart.
Any best practices, like if this becomes more prevalent and I have hundreds, call it, of people now on my cap table, what talk to me about maybe best practice about managing expectations of those individuals, and then should I still find someone that maybe has a lot of significant skin in the game, right? Because if I need a bridge or I really need help with something, like, are those 100 people going to help out and be able to move the needle for me, or should I still think about having like someone that has a majority of the round covered for me?
Yeah, I think this is where there are philosophical differences for sure. I think the party round can be great because you can craft it such that you really can optimize for network or optimize for a variety of skill sets or whatever it is, or both. But there is also value in having a lead. I think a lot of people make the argument of the skin in the game thing. I would argue that actually all these angels have pretty good skin in the game, but despite that though, they may not have time because it's not their day job. And so even if they really do care about their money in your startup, they care a lot about their day job because they've got other priorities. So I think having a big lead where it is their day job to invest large amounts of money and you're one of the few in their portfolio, I think that is a different dynamic. And if you find that right fit, those people can actually help you more just simply because they have the time and bandwidth and it's their profession to do so. And so I think that, what a lot of people ideally want is kind of both, maybe half the round is from some lead and then you fill the rest with some of these helpful folks, but not everyone necessarily has that choice either. And sure. So, there you go.
Kind of maybe a more practical example or question. I think you wrote, let's say you're raising $1 million. And if you go to investors and you say you're raising $1 million, most of them aren't going to commit now. It's better for them to wait. But why is that happening? Or why is it better for an investor to wait?
Yeah, I guess if you just put yourself in the shoes of an investor, and I don't think this is quite game theory, but we can call it that. Like from a game theory perspective, let's say you have a decision tree and you can decide to invest or not invest. Well, that you can probably get in at the same terms a few months from now. So you should always wait, right? Because you can learn more information at the next decision tree point. And so that's why people do that. And so as such, like you as the entrepreneur have to kind of put pressure on investors to essentially make them think that maybe there isn't that next decision point and that maybe this is it. And that really is what fundraising is all about. And I think a lot of people don't realize that. I think a lot of people think, oh, it's about whether investors like my company or not. No, it's about whether investors feel like they will have another shot at this at the same terms.
Yep. And one of the more, I think, brilliant things that you've written about quite a bit, and maybe we've talked about before, but I would love to cover it again. Let's talk about the tranche strategy that you've laid out, because I think we talk to a lot of founders, and you hear it's like, I'm having a hard time finding a lead. It's taking longer than I thought to raise. What is the tranche strategy? How does it work to create some of that FOMO? So you don't get the next decision point in the tree, and maybe wrap that thought with, like, are there any downsides associated with maybe going with this tranche strategy?
Yeah, the tranche strategy, I love it personally because it takes care of a lot of problems. So one problem that it addresses is what we're talking about now, which is it removes that second decision-making point. It really forces an investor's hand now. But the second thing that it also helps with is around valuation setting. So let's dig into both of those. So for valuation setting, I think one of the challenges for most entrepreneurs is, people often ask, like, well, what valuation should I be raising at? And I think the honest answer is nobody really knows, because valuation is a factor of supply and demand, like supply of your round and demand of investors, and you don't know what the demand of your potential investors is. So there's this problem of you don't want to set a valuation that's too low and dilute yourself unnecessarily, but you also don't want to set it too high to scare everybody off, and you may not have a second chance with those investors again. So then what do you do? And that, I think, is a problem. So the tranche strategy basically allows you to test the waters on a valuation and understand where you stand in the market. So if you take like $1 million raise, and let's say we carve it up into a couple of different raises, essentially a raise of, let's say, 300,000, and then later a raise of 700,000, you can test with the smaller tranche your valuation. Go to angels and say, hey, I'm raising on a safe at whatever, 4 million post money valuation. And if nobody bites, you have a problem. Either you've set the valuation too high, or there's something else that's fundamentally wrong here. People don't want to invest in your business. And so that's a signal to you that you probably need to figure that out and fix that. If it turns out that, like, your 300,000 is oversubscribed and everybody wants in, you probably did set it a little low. And that's probably a signal that you can raise it for the 700,000. So maybe you're a bit more diluted than you would have liked to have been, but it's just on the 300,000, which is not bad. So that's one thing that it solves for. And then going back to the question of how do you remove decision points for investors and create FOMO, by splitting up a larger round into these two tranches, 300,000 reduces the supply effectively. And so then investors feel like, well, I have to make a decision on this tranche with special terms. Otherwise, the price will go up. And so if I'm really interested, I'm going to invest now. But if I'm not really that interested, I'm going to just not do this. And so that forces everyone to move a little bit faster than they normally would. So those are the two things it solves for. I think in terms of the downsides, the biggest downside is in the communication of it. I've seen founders really mess this up, where it's, they go to an investor and say, hey, I'm raising at 4 million post money. Let's say that tranche gets oversubscribed, and then that investor hadn't yet responded. And the founder goes back to that investor and says, oh, you're in? Well, actually that price is gone now. It's now 10 million post. And how do you think that makes an investor feel? Like emotionally, it doesn't feel good. And so with this tranche strategy, you have to over communicate. If you're getting close to filling your tranche, you should be emailing everybody you told about this special number. Like, hey, I just wanted to let you know that I only have 50,000 left. And after that, I'm sorry, that's all I can, that's what I can do. So really over communicating everything. You can't change things on people because they will not feel good.
Mm-hmm. Super, super helpful. I think that's a great takeaway. Is it fair to say you don't need a lead for the tranche strategy? Like, you as a founder can kind of set the terms of the safe and close money as it rolls in, and you can remove some of your heartburn there of, like, not necessarily needing to find a lead because you can do it yourself?
Yeah. So with the tranche strategy, you can go and set the terms. Now, with the tranche strategy, you can also fundraise from potential lead investors in parallel, but the framing is slightly different because lead investors want to set their own terms. So I think the framing with when you go to a meeting with a lead investor or a potential lead investor, you essentially say, hey, we're raising $1 million. And while we are open to leads who are a good fit and considering those terms, we are also in parallel not holding our fundraising back. We are raising on a note right now, but we are also open to a price round. So that's kind of how you do both. And then what ends up happening is if a lead does come in and says, oh yeah, actually I want to just fund the whole thing, but you've already started collecting notes or safes, that's fine. You end up just converting your notes or safes into the round at that priced amount, and everyone's actually generally pretty happy with that.
Yeah, there you go. Super tactical. I love it. Let's go on to like the seed to Series A, because I think you mentioned it requires a more buttoned up approach. Belt plus suspenders. How should founders think about like the Series A? And maybe let's start with metrics first. Like, what does my business need to look like for me to have a successful Series A raise?
So Mike, we're doing this in 2021 where the market is just insane. And I feel like I don't have a great answer anymore. I think a year and a half ago, I would have said that for the Series A, for most companies, you should probably be looking at least $1 million run rate. I think if you're extra good at fundraising and are in a hot space, you don't have to have quite those metrics. And if you are not good at that, and you're not in a hot space, you should probably have above that, probably closer to 2 million run rate. That's probably what I would have said. However, I think in this market, I'm just seeing everything, like literally everything, where that still holds for many companies. But in this market, I think there's a select few companies that are just being thrown money left and right. And it generally is along the lines of because of either who the team is or because of how hot the sector is, in which case I'm seeing companies that have near nothing raise Series A's. The other thing is the valuations on the Series A's are all over the board. I think a year and a half ago, I would have said Series A's are anywhere from 20 million pre-money up. But now I would say that that would be a low end of a Series A. Some of these really hot Series A's are like 100 million pre and up.
I'm not asking you to predict, but I guess I will. So like, how does this, maybe game theory this, like how does this play out for founders that are doing this 18, 24, 36 months from now? Raise the Series A at a $70 or $100 million valuation with less than $1 million in revenue. Like, what does that mean for me as a founder, and how should I think about this?
Yeah, so on one hand, it's great if you can get phenomenal terms, but I would also be cautious because you have to hit the milestones of the next stage. And if you're not anywhere close to that because you were able to raise a Series A pretty early on, then that's going to be tough, right? Because Series B milestones, I would say a year and a half ago, it would have been closer to 10 million run rate, anywhere between 5 to 10 million run rate. These days, I would say that's all over the board as well. But maybe in 2 years, it'll be back to that. And so if you're basically at nothing and now you're trying to get to 10 million run rate, that's a really tall order. Mm-hmm. So I would say that it's really important to be cash efficient. And that can be hard if you have a board that's putting a lot of pressure on you to just spend money in a span of 18 to 24 months when you don't yet have product market fit. I think for companies that do have product market fit, where they have a repeatable process, they know the value proposition, why people buy, and it's just a matter of executing on it, and it turns out that you get a preempt to Series A, then that's probably an okay situation. But if you have no product market fit and you're still trying to figure all of that out, I'd be very conservative in how you spend your money, because I think you'll need to make your money last like just a lot longer. And that also means setting expectations with your board that you're not going to burn until you figure that out.
Mm-hmm. Yeah. These questions might also like, hey, the time is, it's way different now, but how does my Series A deck or content differ from maybe my seed round? And then maybe a second follow-up question to that is like, do you think founders need a pitch deck even for a pre-seed or seed round? Like, have you guys done deals without those things?
Founders don't need to pitch with a deck, but I would recommend at a minimum preparing a 5-slide deck. It can be really rough. Problem, solution, team, market or traction or whatever, something along those lines, just so that way a lot of investors will ask like, hey, what is the basic information on this company that I want to review before taking a meeting? So just being able to send that out, I think will save you a lot of time. And then you can just totally have a conversation during a call instead of pitching off of a deck. So that's totally fine. It's been like that forever at seed, whether it's pre-seed, seed, post-seed, it's pretty informal, however you want to do it. I think the way that I would go into this setting expectations with the investor is, hey, is it cool to just have a conversation about the business? And again, just over communicating everything. Like if you're pitching like, hey, I prepared a deck, okay to walk through it, or, hey, is it cool to just have a conversation? So that's what I would do. But Series A is a lot more buttoned up. Series A, you really should spend time on the story and the deck. You should have appendix slides for a lot of the details. And I think especially if we are thinking about Series A's, traditional Series A's, where you actually have numbers to show, like the more you can do around your metrics and the details around your customers, the better. Like, what are the case studies on the customers? Do you have enough data to do even cohort analysis? Like, you should know your CAC and your LTV. Obviously, these things will change, but the expectation is you will have a much stronger idea of how your business works at that stage, down to the nitty gritty. And that should certainly go in the deck at a minimum. And then even more extensively preparing a deal room with some of these other things, whether it's, customer testimonials or whatever else, like will strengthen your case. I would say this market, again, is pretty wonky, where I'm seeing a lot of Series A deals happen without really anything. But I would say that's not my prediction is it will revert to some level of normalcy where that will not happen forever.
Yeah. For founders, I think we tend to maybe under index on how much time fundraising takes. And maybe going to some of our, putting our marketing hats on, do you have any like benchmarks or conversion data on how many investors a founder should think through or talk to, take a meeting with, close? Let's call it for a seed round, like my first maybe institutional round. Like, how should I think about maybe how much time it's going to take me, and like how many meetings and do I actually need to set to kind of get that funnel down to like one term sheet, ideally, hopefully more. Like any good data there?
Yeah. So fundraising just takes a lot of meetings. And I would say, let's say that an old version of a seed round, $500,000 to $1 million, I think people should be prepared to take anywhere between 100 and 200 investor meetings. And this includes small angels as well as larger funds. But that's the level that I think people need to be prepared for. Now, I think you will have your answer as you go along. Like, let's say that you've done, 30 meetings and you're not close with anybody, maybe you stop. But I think I often hear founders say, oh, nobody is committing. And well, how many people did you meet with? 8. Like that's not going to cut it, because part of it is you need to have a lot of meetings to meet with the right people. I think one of the challenges, which honestly, I can see it as a big frustration with my founders, is you don't really know what investors like. Everybody has some generic website of, oh, I invested in software and we invest in everything. Well, what does that really mean? Like, what are you actually interested in? And the reason everyone has a general website is they don't want to miss anything, but it's also not helpful in guidance. So you'll have to meet a lot of people to understand like who really is a good fit. And then the other thing is you'll probably end up changing your story along the way. And that doesn't mean change your business, but as you hear concerns or things you need to address better, you'll want to shape your own messaging in your pitch. And so your pitch will hopefully get better over time as well. So you're going to probably burn through a lot of meetings. And it would not surprise me if people burn through, 10 or 20 meetings before kind of starting to hit their stride. So that's why it's important to do a lot of meetings.
Do you think it's important to maybe put your, call it unqualified or maybe not as qualified investors early on to burn through that for practice? Or should I put my top tier ones early on in terms of my fundraising strategy.
Yeah, everybody has a different tactic here, and I'm not really sure what the best
Yeah.
strategy is. Eric, my business partner, likes to recommend that people put sort of their second tier investors first. So they're great people, but they're not your top picks, and get your story figured out with them first before going to your top tier. But I think I don't know. It's really hard to say.
Yeah, fair enough. Okay, we're gonna wrap with 3 questions that we've been asking all of our investor guests this season, and hopefully we can create some super actionable things for founders. What catches your eye in a cold email from a founder?
Definitely has to be concise as a starting point. And then in that brief, copy that you have, essentially it's just hitting the punches, like, building rapport. So it's a little bit personalized. I understand you're probably still mass emailing this to everybody, but at least you got my name right, hopefully, and got something a little bit right about why I might be interested. And then, a couple of talking points about what is great about your company. Maybe it's you landed a couple of key pilots. Maybe it's you have 10 years of domain experience in this and found this problem, or maybe it's you actually have, I don't know, something notable about whatever. And then lastly, strong call to action, making it very clear that you're looking to pitch, like what is the best way to get your thoughts on our fundraise, or something.
Yeah. What's the number one thing founders can do to help speed up their funding process?
I think it really comes down to just packing meetings together to create that FOMO. Spreading out the meetings just drags on the process. And
finally, if a founder thinks they're a good fit for Hustle Fund, any tips for increasing, like, how does your process work? You guys are doing, 15, 16 deals a month. Like, how do I get in touch with you and be one of those 16 companies?
Yeah. So everybody goes through the same process. Even if you were referred in by my best friend, or you're totally just cold, completely cold, everybody fills out the form on our website as a starting point. In fact, people who are warm intro to me or people who know me, I ask them to fill that out, because we want the same information for every company to be able to, look objectively at the same thing. So that's the starting point. Now, where we can do better, and I've been literally saying this for years now, so we haven't quite solved this, is we have a lot of applications and we are so behind always on that. It's something we are working on, but that can take a while. It can take us a while to get back to people. So here's like a key tip, and I'm a little bit hesitant to give out this key tip. After you fill that out, if you cold email us, or you ping somebody to ping us, that will usually encourage us or push us to look in the pipe drive that in our CRM at your application sooner. So while we have the same standard process for everybody, like where you are in the queue, I think people who do hustle, for lack of a better word, end up getting a response faster.
There you go. Elizabeth, always a pleasure. Thanks so much for taking time out of your day, joining us and sharing some of these thoughts, and we'll talk to you soon.
Thanks, Mike.